Good evening, everyone. Time for another silver update. Wanted to do a quick shout out for forums.silverstackers.com. It's a message board that one of my readers runs, and I want to do a shout out for them because they've got a new message board, and the silver board is the biggest one here. A lot of entries, so if you want to go to a new silver board, I highly recommend this board. I'll put the link down below. Wanted to read one of my viewers asked a question. Hi, Brother John F. First off, I can't say how much I respect you for spending the time you do to help educate us folks on YouTube. I'm going to go really quick here because I have a lot of things I want to cover, so if I read too fast, just watch it over. It's because you and others on here that I found out about markets and why precious metals, it's metal, it takes metal to invest in metals, are only going up. So thank you very much. You played a part in the welfare of myself and my family. I was hoping you could shed some light on why folks would not go all in into silver as opposed to going into gold and silver. I know folks say that gold is more stable and therefore is more an insurance policy, and silver is more for the explosive gains. But if someone believes enough in PMs to go all physical, why would you not go all silver, since it's the most undervalued option? I just can't seem to find an answer that makes sense. Well, I replied back and I gave my allocation. I calculated it, and it comes to what I hold is 99.8% silver. The other 0.2% is palladium and gold. Roughly 0.05 gold and 0.15 palladium. So 99.8% silver. So you know where I stand on that one. Here's the latest silver chart. It is approaching my predicted high of $40. We hit 39.78, and we're pulling back. I've drawn some lines here. I expect to pull back to at least 38, perhaps 37, and a long shot odds for a big pullback would be 31 or so. So those who are looking to buy the dip, I would recommend maybe a third at 38, a third at 37, and a third at 31 if we get it. Otherwise, if this MACD resets down to the zero line, you might want to just, whatever the price is when we get back there, you want to buy, because you have to remember that in a bull market, the MACD gives good signals on the low, buy, 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 and false signals on the high, sell, 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 and sell. So you want to take the buy signals and ignore the sell signals. So we're going to wait for the pullback if one comes. Remember, we're approaching parabolic. We are in parabolic in the long term. In the really long term, we're clearly parabolic, but you have to remember the fundamentals. So I wanted to segue into some free charts that are out there I want to make you aware of. It's from More Research. You can find it at mrci.com/PDF, and it gives you some long-term charts, really long-term charts. So if you want to look at the silver, we've got all the way back to 1973. You can see the run there was a huge run, and we're approaching nominal highs. So just to give you comparison, let's look at some other commodities. Gold, for example, we've easily surpassed these nominal highs. We're into new nominal highs. Cotton is hot right now, way into new highs nominally. This is what you'd expect in inflation. The ones you wouldn't expect are things like corn and soybeans. So, well, corn is nearing a new nominal high, but if we look at, let's take sugar. So you might think that sugar is overbought, but if you look at the nominal highs all the way back to 1973 and 79, we're still not anywhere near there, so still maybe a buy. I don't see the inflation calculated into these markets yet. CRB cash index, we surpassed the 2008 crash and the new highs. So good site to go to, and I wanted to use this to segue into what I really wanted to talk about tonight, which is interest rates. So let's go ahead and look at the 3-month euro dollar. Now, they don't have a chart for T-bills, they just have euro dollars, but essentially euro dollars match T-bills unless you're in a crisis situation, and then you're looking at the T-bill euro spread. It's called the TED spread. It's not really a factor right now. It's for those who like to play dollars held domestically versus dollars held in foreign banks. But anyway, if we look at this interest rate on the 3-month T-bill, this is a 90-day note, so you loan money to the government for 90 days and you get paid back. It's discounted based upon the price, so what happens is you pay whatever this price is and you get back 100. So the current price is 99.680 and you get back 100 in 90 days. So what it is effectively yielding is essentially nothing. So to understand debt markets and how they work, you need to just think about a simple loan. Let's say I'm loaning you money or you're loaning me money and it's 90 days. What's the risk? There's 2 risks that you need to think about. The first risk is the borrower credit worthy? Will he be able to pay you back the money he borrowed? That's a default risk. The next risk is, will the currency that you're paid back in be worth the same thing as it was when you loaned it? So that's a currency risk. So those 2 risks, the risk you won't be paid back and the risk that the dollars that you're paid back in will be worth less than the dollars you loaned. Now, on a bill like this, a 90-day bill, it's not very likely that inflation could change that much in 90 days. So you have a very low interest rate. Now, these rates are set by the Fed directly. They have direct control over these rates. They just simply declare them to be what they are, T-bills, and the whole short end of the yield curve. And I'm going to use that to segue into the yield curve. Now, this is a site you can go to, and it's from the Treasury, and I'm going to take the real rates out here and just do the nominal. You set the date here, and this is where we are right now. So what the yield curve is it shows you rates for all the different maturities of government debt. So on the far end, you've got 1-month Treasuries, 3-month, that's the T-bill we were looking at, 6-month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, and 30 year. There is no 20. 30 is effectively gone because they did away with it, but it's still calculated here. So these are the time frames you're loaning money to the government at. Now, like I said before, the government directly controls, the Fed controls these rates. And you can see that these rates are ridiculously low. So your retirees, your pensioners, your people who are on a fixed income, they are trying to play it safe and just get enough money to survive using their nest egg. Well, you can see the rates they're getting. That's nothing, 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 and nothing. Even at 1 year, we're still less than 0.5%. When we get out to 2 years, we're less than 1%. And we get up to 3 years, we're almost at 1.5%. So the Fed has compressed interest rates to a ridiculous level, and I'm going to take you to some comparative time periods so you can see. So what you want to do is choose a date here, and let's go back to a date I want to look at, for example, is 1995. This is a comparable date because this is roughly 3 years into the Clinton recovery. Okay, so they lowered rates. If you remember the last chart we had on T-bills, that was the last time we pegged those rates really low. So we go back to 1995, and you see that how the yield curve is rising dramatically in that time period. So people who loaned money to the government For just 3 months, we're getting 6%. It seems incomprehensible, but that's what the rates were. So let's look at the Bush recovery. We had a near crash in 2001 and then a rough recovery in 2003. So we'll look at the yield curve at that date. This is when they were trying to bring back the economy after 9/11, after things had fallen off, after the dot-com crash, and we had 1% pretty much all the way out. And then once we had started to recover and housing started to boom, let's look at 2005. You can see that the yield curve came up. So all the old folks and retired folks, they could buy some 3-month T-bills, 6-month, 1 year, get 3.5%, something like that. So something they could live on. So let's return to today. And you see how we have a ridiculously compressed short-term end of the yield curve and not very high rates even on the long term. So I wanted to use that to segue into, I talked recently about Mr. Prechter, and there's Mr. Denninger out there, the deflationists who believe in deflation is coming. One of the bases of their theories is that if the Fed ever decides to monetize the debt, the bond vigilantes will step in and make them pay. So let me read this to you a little bit so you'll understand. A bond vigilante is a bond market investor who protests monetary or fiscal policies they consider inflationary by selling bonds, thus increasing yields. You have to understand that. The price of bonds are inverse to the yield. So as bond prices rise, yields fall. As yields rise, bond prices fall. In the bond market, prices move inversely to yields. When investors perceive that inflation risk is rising, they demand higher yields to compensate for the added risk. As a result, bond prices fall and yields rise, which increase the net cost of borrowing. The term references the ability of the bond market to serve as a restraint on government's ability to overspend and borrow. So let's go back to what we were looking at before. Well, I've closed that out. But if you remember that chart, we're running a $1.6 trillion deficit. So what would you expect from that? You would expect that the bond market vigilantes would sell bonds, right? And if the bond market vigilantes sold bonds, you would expect to see this curve rise across the board. So it could look, I don't know how far this goes back, but let's look at 1990. So if bond investors were afraid of the Fed watering down the value of money, and the money they're going to be paid back in is not worth the money they lended, then they're going to sell those bonds and increase rates. So the question becomes why, when the fiscal situation of the U.S. government is the worst that it's ever been in history, are these rates so low? And we know they set these rates down here. The question is, why are these rates so low? The 10-year is yielding 3.5%. So the question is, where are the bond vigilantes? Well, this is a key to understanding why people like Carl Denninger and Robert Prechter and every other deflationist is dead wrong. Because the bond vigilantes don't control the bond market. The Fed does, through quantitative easing. Once the Fed begins to buy long-dated bonds, in other words, the Fed sets the rates on these 1 month, 3 month, 6 month, 1 year, etc. It just sets them by loaning in the interbank market to banks, and then the banks can lower the rate they loan at, et cetera, et cetera, et cetera. But the long bond is supposed to be controlled by foreign creditors and investors, but it's not. So if the Fed, which has the ability to print up infinite amounts of money, simply takes that money and buys the treasuries issued by the U.S. government, then it has the ability to artificially suppress long-term interest rates to as low as it wants. That's what we're seeing. That's what quantitative easing means. It means that the Federal Reserve is using counterfeit money it's printed out of thin air, to buy the debt obligations of the United States government and to artificially suppress interest rates. So that's why you have this chart, because this chart is inflation in the price of silver. You're not going to see inflation measured in the bond price, because the federal government is rigging that price. Here's your T-bill, but you could also look at your 10-year note. When you look at the 10-year note interest rate, well, this is the price. So this price should be, where should it be? Well, let's think about it. Back in 1980s, this is 82, this is near when the bond was 60. This is when we were looking at 15 to 20% long-term interest rates. This is where Volcker slammed the brakes on inflation. So if Bernanke wants to slam the brakes on inflation, which is actually going to be much, much worse than what we saw in the end of the 70s, he would have to let the bond market sell off down to here, which would cause 15 to 20% interest rates. Well, he's not. He's buying these bonds. He's artificially supporting the price of these bonds and therefore artificially suppressing the interest rate on these bonds. So the basic point is this. There are no bond vigilantes. They don't exist. No one is buying our bonds except the Federal Reserve and proxies of the Bank of England and Caribbean banks and whatever they can convince the Chinese or Japanese to buy. But bond vigilantes don't exist, and for that reason interest rates are not rising, and for that reason there's no reality to the price of bonds or the deficit that the United States runs. So the question is, how long can this go on? Well, people like Jimmy Rogers have said that, and he predicted this, he said that when the Fed begins to buy bonds and monetize the debt, then you will see a collapse in the US dollar. Now, we are seeing a relative collapse in the US dollar, but nothing that you would expect to see if what is happening is really happening, which it is. So why is that? Well, because the US dollar is a cross of all other currencies. And the Federal Reserve is a bank of multiple banks. Here's your dollar-yen cross. So they not only use the money they print to buy their own debt, but they also influence foreign banks to print money of their own and to support the dollar. So it's essentially a race to the bottom for all currencies. So there's no instrument, there's no relative currency instrument to measure this race to the bottom, because they're all compared against each other. The only accurate instrument to measure this race to the bottom is the price of gold and the price of silver, which are going relentlessly up because the governments of the world have taken over their bond markets and are buying all of the debt, including the long and the short-term debt, to artificially prop up their respective governments to keep them from collapsing from the unsustainable debts that they have. So I hope that gives you an idea of how these debt markets work. There are no more bond vigilantes. The bond vigilante is extinct. And Bill Gross and all the rest are in bed with the government, and they're all betting on a complete collapse. So Again, the only way you can protect yourself from the coming cataclysm is physical metal. People have asked me recently, well, I've got a lot of profits in silver. Should I sell them and get back in? I've dealt with that before, but I want to say again, this is a market to protect yourself from what's coming. If you try to buy and sell this market to make your profits, you might get lost and not back in. This is not a market for you to try to make money off of. This is a market for you to save your money in. Your savings are in silver. It's not a gambling casino. This is a place to place your savings. So I don't recommend gambling with the price of silver. The goal is to accumulate as many ounces as you can, so when this entire Ponzi scheme collapses, you will have something that you can sell in the new currency. And we'll talk to you next time.